How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. I am back and ready to go. I wish I could say I was tanned and rested, but but I'm not. A week away at banking school has kind of drained me a little bit. Recovering here nicely though as I come back in. But today in this episode, I wanted to talk about the Federal Reserve's decision this week to hold interest rates steady, and we're just going to look at a couple of articles here talking about the Federal Reserve decision. But first, I just wanted to read a little couple notes here real quick that I made down. So as expected, the FOMC did not change its benchmark rate range from 5.25% to 5.5% for the seventh consecutive meeting. The Fed also updated rate cut projections for 2024 from 75 basis points to 25 basis points and increased 2025 rate cut projections from 75 basis points to 100 basis points. So the median forecast for PCE inflation increased to 2.6% from 2.4%, and the core PCE inflation forecast increased to 2.8% from 2.6%. The economic growth estimate from 2024 remains unchanged at 2.1%. So market reaction, we'll talk about this a little bit more in an article I'll show in just a second. The S&P 500 ticked up to 5430. The U.S. Treasury 2-year is down 12 basis points to 4.72%, and the U.S. Treasury 10-year remained unchanged following the announcement. The market is pricing a 58% chance of a 25 basis point rate cut at the September 2024 FOMC meeting, and the FOMC announced the following actions and analysis. So it was a unanimous policy vote. If anybody has followed my review of the Lords of Easy Money, you would know that it is standard to have a unanimous policy vote in Jeremy Powell's Federal Reserve. Dissent is not allowed. The Fed changed its statement from lack of further progress to modest further progress toward its 2% inflation objective. That's as clear as mud. The Fed noted that although inflation has eased somewhat, they would like to see more good data before cutting rates. Powell says the labor market conditions have returned to where they were before the COVID pandemic. The Fed cut the Treasury runoff cap to $25 billion from $60 billion. That's pretty important note. Okay, so now let's actually go. I'm going to bring a couple of things in here real quick. Let's actually go to the FOMC statement and just see very quickly what they said. So recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have remained strong and the unemployment rate has remained low. Inflation has eased over the past year but remains elevated in recent months. There has been modest further progress toward the committee's 2% inflation objective. The committee seeks to achieve maximum employment and inflation at the rate of 2 percentage points over the longer run. The committee judges that the risks to achieving its employment and inflation goals have moved toward better balance over the past year. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. Its support of its goals, the committee in support of its goals, the committee decided to maintain the target range for the federal funds rate. Is considering any adjustments to the target range for the federal funds rate. The committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The committee is strongly committed to returning inflation to its 2% objective. So, how did the market react to this, as we said a moment ago? So let's go in here. So stocks rise after Fed holds rates steady, projects 0 to 2 rate cuts. So U.S. bank stocks rose June 12th, this is a couple days ago, after the Federal Reserve announced it would keep the federal funds rate in the 5.25 to 5.5% range and projected no more than 2 potential rate cuts this year. The KBW NASDAQ Bank Index closed up 1.39%, while the S&P 500 rose 0.83%. The biggest bank stock movers for the day included Western Alliance Bancorp, Comerica, Regions Financial, and Truist Financial Corp. We could see the yield curve here still kind of moving, still inverted, but yet moving closer. But there's, still a decent gap there. Um, the federal markets, the FOMC, has increased its benchmark interest rate by a total of 525 basis points since March of 2022, but it has left rates the same for 7 straight meetings. July 2023 was the last time the FOMC raised rates. And then let's see here. Top return, 20 banks capitalized. Okay. And then finally, the last article I wanted to show, and this was from yesterday, Thursday, June 13th. So Fed's timing on rate cuts remains murky as inflation inches toward 2% goal. So interest rates will remain relatively high this year as the finish line for the Federal Reserve's policy battle remains out of view, and officials now forecast just one rate cut in 2024, even as a key measure of inflation has fallen to its lowest point in more than 3 years. The Fed, as expected, kept its benchmark interest rate unchanged after its meeting June 12th. Central bankers who began hiking rates have not moved their federal funds target range since July of 2023, and the Fed's quarterly economic projections released after the meeting, the majority of Fed officials now expect just one rate cut this year, down from 3. During a post-meeting press conference, Fed Chairman Jeremy Powell said that while inflation has eased notably, it is still too high to justify a rate cut. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. And then down here, it says basically inflation slows. The latest Fed decision came just hours after the release of the newest government data showing that the consumer price index, the market's preferred inflation metric, increased 3.3% from May 2023 to May 2024. Core prices, which remove volatile food and energy, the stuff that really matters, rose 3.4% annually, the smallest increase since April of 2021. But if you add food and energy back in, it's still way up. So, okay. And then we have, this is important. So the Fed's preferred inflation gauge, the core personal consumption expenditures, PCE, fell to about 2.8% in April, its lowest point since March of 2021. But an uncomfortable plateau could set in this summer as prices in some categories remain relatively sticky. Yes, and I would agree with that. And so here we see there's some good charts here, kind of year over year inflation in May of 2024. You can see electricity, fuel, gasoline of all types, propane, kerosene, and firewood are down a little bit. Frozen food, frozen non-carbonated juices and drinks, 19.5%. Uncooked other beef and veal, 7.7%. Frankfurters, 7.3%. Bacon and related products, 6.9%. Sugar and sugar substitutes, 6.4%. Commodities, photographic equipment, 8.7%. Cigarettes, 8.5%. Indoor plants and flowers, 7.7%. Men's shirts and sweaters, 7%. Non-prescription drugs, 5.9%. Admission to sporting events, 21.7%. And this is for services. Video discs and other media, 20.7%. Motor vehicle insurance, 20.3%. Yes, I actually got my auto vehicle renewal for this year, and I can confirm, yes, 20.3% sounds like a good number. Care of invalids and elderly at home, 11.1%, and motor vehicle repairs, 9.5%. So yes, they take these core numbers and they chop them down, okay, to make them look as good as they can. But again, when you look at these other numbers by energy, by food, especially by services, by commodities, you can see here that, inflation's still way up. And then we got a chart here on kind of wages growing faster than consumer prices. Maybe. Okay. So that's basically what I had to show everybody. So again, the Federal Reserve holding rates steady this week for the 7th consecutive meeting. They are now only projecting one rate cut for the rest of this year. We have a 58% chance that is going to happen at the September meeting. I did not expect anything to happen at this meeting. I did not expect anything to happen through the summer, unless there's some major things going on. Usually June, July, and August get pretty quiet at the Fed. Just like they do on Wall Street, as the old saying on Wall Street goes, sell in May and go away. As all the Wall Street brokers would historically travel to their beach houses for the summertime. Now, and then also, you have this election year going on, which is also adding kind of further complication to the mix, if you will. So I do think that I think that this projection right now is probably pretty accurate. I think we'll probably get one rate cut in September for 25 basis points, and then they're just going to sit tight the rest of the year, wait for the election to blow over, see what happens, and then basically go from there. I have said before, and I'm still sticking to my thing, I do not believe that inflation is going to get back to 2%. I just believe you have way too much government spending. And until the monetary and the fiscal houses can both work together to defeat this thing, I don't see it. I just don't see the inflation coming back down. And and Jeremy Powell even admitted as much this week about part of the thing that he admitted was about the jobs report, basically saying that yeah, you know what, the jobs report numbers may not be as good as what the headline numbers would suggest, and I'll get into that in another episode. But yeah, I think the data is highly suspect on some of these things, particularly when you look at GDP and the jobs report. And I think even inflation is in some of these different inflation, the CPI, PCE, PPI. Yeah, I think some of these are adjusted likewise to make them more favorable for the administration. So that's just my view. That's my take on it. But yes, so I'll wrap up with this. I hope you enjoyed this episode. It's good to be back with everybody. Like I said, it's after almost a couple weeks off. And like I said, I got to stay in the rhythm on these things. Yeah, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to check us out on YouTube, Rumble, and all major podcast platforms. Please feel free to leave your comments down below. I always love getting back to everybody, and I will see you again in another episode real soon. Thanks a lot.